Thank you, everyone, for joining this conversation. I'm very thrilled to have, and Mike, thank you for sitting down with me today. What a time to be having this conversation. I mean, private credit is dominating the headlines, and if it's not that, it's other forms of volatility, be it concern about disruption of AI. And now the latest one we have to grapple with is the prospect of war and geopolitical uncertainty. Has that changed any of your assumptions for how 2026 plays out?
As surprising as this may sound, not really. And the reason being, as a private markets manager, we're thinking in 5, 10, 15-year increments. And you and I have had this conversation before. It's actually an interesting place to live as a publicly traded company that can experience the day-to-day volatility in markets and has to react, at least emotionally, to the daily headlines. But when we're making investments behind secular themes like realigned supply chains globally, the reindustrialization of the U.S. economy, digital infrastructure, and digitization, these are not things that get knocked off track by the things that we tend to talk about day to day. So inevitably, the world that we're living in may change geopolitically. We may see realignment of alliances. Energy prices has a big impact. We may see inflation come back in. So that's going to have an impact on certain things that we own, and we will react. But one of the nice things about being a long-term investor in the private markets is we don't really have to say, okay, the playbook that we had put in place for ourselves is now fundamentally different.
Have you started to think at all, again, early days, but of resurgence of inflation? If the Fed isn't able to cut as much as we assumed, how would that change things for you?
Well, it's interesting because part of this private credit story, as an example, and I saw it on the walk-up, the way that most large private credit managers are set up is that we're kind of hedged against outcomes. So if software disrupts a sector of our portfolio, then our digital infrastructure and data center development business benefits. If software disrupts the portfolio, then our renewable energy business benefits. So when we think about inflation, what's interesting, the private credit narrative is also around base rates coming down. So there was this anxiety that crept into the market that as base rates were coming down, the return available in private credit would somehow become less attractive. If we find ourselves in an environment where we still have inflation and rates are elevated, that's actually theoretically good for total returns in private credit. So I think you have to start thinking about both sides of every coin, and most of the things that we tend to talk about on a day-to-day basis have a risk and an opportunity associated with them. And when you look at a broad-based manager like Ares, we tend to be on either side, and so we tend not to get that worked up about any.
Just hearing you talk about that, though, let's take the software AI example. Not every platform has the size and scale to balance out a software exposure with AI infrastructure. So these pains we're seeing, if you can benefit by being diversified, what happens if you aren't? Is there a shakeout to come in this industry?
I think investing 101, and Mark Rowan just talked about it too, diversification is a big way to mitigate risk. It's also a way to dampen return if you focus too much on diversification. So we're constantly trying to find that right balance of making sure that we can capitalize on volatility. And one of the ways you do that is you understand deeply what you own so that when the markets get dislocated or disrupted, you can push in and play offense. Inevitably, if you are concentrated, whether it's AI or we saw it in the energy shakeout 5, 6 years ago, there are going to be winners and losers. Generally speaking, those that are more diversified will survive, consolidate, and probably grow disproportionately.
We've already started to see some consolidation. I have to say, I feel like you and I have been talking about consolidation for years. Does it feel at all that it's reaching a head at this moment, that you really are starting to see some funds that are limping along and their only odds of survival are to become bigger and join a larger platform?
So we've been talking about consolidation for over a decade.
Sure.
And back to secular themes driving the growth in private markets and capital formation is consolidation. So unlike investing in the public markets, size is not the enemy of performance in the private markets. It's quite the opposite, because the larger you get, the more resources you have, the more you can invest in local origination, product development, large balance sheet. the more relevant you are to customers, the more relevant you are to global investors. So size is not something that we necessarily pursue as an end goal, but what we're all experiencing is that the larger we get, the better our performance is. Consolidation is not about limping along and getting subsumed. There's been some of that, right? We acquired ACAS and Allied and other public companies coming out of the GFC, but it's more the high quality monolines. So to your earlier question about lack of concentration, if you're a infra-only equity manager, or you're a single geography private equity manager, but you have a 25-year institutional track record and a legacy that you want to sustain, you will try to get consolidated from a position of strength, not a position of weakness. That being said, if we continue to see the type of volatility that we're seeing now, I do think that you'll see, some of these weaker players get consolidated out.
What does that look like if you are not specialized, but you're still one of these kind of middle-sized players? Are they going to see a real squeeze right now?
I think so. The global LPs are looking to allocate more dollars with fewer managers. And they want to do that because they want better economics, they want better access, they want better information and analytics. And I think they're also seeing that scale drives performance. And so as this consolidation happens, you're going to see the large get larger. You're going to see niche, real alpha generative managers continue to thrive. And then I think everyone in the middle is going to have to really prove that they can, generate alpha, or they're going to get squeezed.
By the way, just to point out, because I don't think you can do it, or perhaps you're too humble to do it, last year you raised two of the largest ever funds, $30 billion and $35 billion in direct lending. And that feels like evidence of its very self, of the big getting bigger. So in a winner-take-all environment, or winner-take-most, 5 years from now, what is going to be the size of this industry in terms of number of platforms? Are we talking there's just 5 to 10 players? Is there more than that?
Yeah, I don't know. If you look, you have to look for an analog. And generally speaking, in financial services, players can max out at a 25% market share, and then you get diversification below that. So you can look at the banking industry where you have 6 or 7 large platforms. You can look at the insurance industry, and you can see that consolidation too. So I don't know if it's 5 or 10, but it's going to be a handful. To your point, though, on the capital formation, last year we raised about $115 billion, which sounds like a big number in the grand scheme of the markets and where we were 5 or 10 years ago. We actually put $145 billion to work. So as you're consolidating capital, you're also consolidating the ability to deploy that capital. And so that's part of what compounds this market leadership.
So how are you thinking about the Ares platform specifically as this trend unfolds, as it makes sense to have scale? Are you looking at growing not just organically but inorganically as well?
Yeah, our history of growth has been a healthy combination of organic and inorganic. About 75 to 80% of our growth historically has been organic, 20 to 25 inorganic. We tend to lean into an acquisition when we see a market that is going through some kind of transformational change or secular shift, where we think we have a right to participate and win, but we just don't have enough scale, or we're missing a key piece of information edge, or we don't have the right distribution. And so when you look at where we're acquiring, other than small tuck-ins that we'll do, it's going to be in big transforming markets like data center development or wealth distribution. Most of those boxes, frankly, are checked for us right now. And so most of the growth, I think, for the foreseeable future will be organic, leveraging the competitive advantages that we have on the distribution and investment side to grow within the business. But there are still a couple of things that I think would make sense for us.
Well, part of the thing, and actually let me get to that first. What would be those couple of things that make sense for you?
Yeah, we've been public about this. I think getting larger in private equity could make sense for us. We've been in the private equity business for as long as we've been in existence, but it just hasn't kept pace with the rest of the business in terms of real estate, infra, and credit. I think there's an argument that someone of our size and global reach should be larger generally in private equity.
I mean, there's a lot of players out there, and probably a lot of smaller players who would love to be part of the Ares platform. How do you evaluate that when you look for potential managers to buy? What are the characteristics of a good private equity? equity bolt-on to
I just realized now my phone is going to be ringing all day from every investment
Everyone's going to be
banker
pitching you, for sure.
Look, it's all about track record, and this is something that people don't talk about enough, and so I'm going to answer your question a little bit differently,
Sure.
because when you get into a world that we're living in now where you're seeing outflows and volatility in stock prices, it all comes down to fundamental performance, and top quartile, top decile performers that can demonstrate that they can deliver outsized return in any environment grow. So we have a simple saying at Ares that assets follow performance. If you perform, you grow, and if you do well for your investors, they do well by you. So particularly in markets like private equity, and frankly, when you get into the equity part of the capital structure, even in real assets, performance is kind of the top criteria. And then I think it's about, can you really generate alpha? And this is going to be the big shakeout in PE. We're coming off of a decade where you had a lot of beta players who, because of the rate environment that we were in and because of the nature of supply demand in the market, were generating what looked to be best-in-class returns. And now that arbitrage is gone, and you really have to, you're going to get an opportunity to see which private equity managers can really make companies better and transform them. And I think those are the ones that you would want to own.
Do you think they're far and few between?
I think there are. I think if you were to actually look at the math, and this is something that we do in our secondaries business, when you look at the number of managers globally who can really generate alpha consistently, there just aren't that many. It's actually a very unique skill set. So I think people are going to be paying a lot more attention to that over time.
Can I ask, because a lot of times people use the corollary of hedge funds, a medallion fund that can only grow so big because if you're too big, you eat away at alpha, that scale matters in this. And people love to point to the private capital industry, be it credit or equity, and say they're growing really rapidly. They're going into retail. That means that deal quality is being sacrificed in order to put assets to work. Is there a type of environment evolving right now where alpha is being eaten away at because the industry is growing too rapidly?
I don't think so. I mean, I'm sure that there are players who haven't built the origination or portfolio management capacity to drive alpha through this type of market. But I just look at our track record over 25 years in the private credit business, and it's been a 12 to 13% plus asset level return through everything that's been thrown at us, with loss rates near zero. And so I think that's something that people will continue to have appetite for. But this is the thing that's tough. When you're investing for the long term, we're not going to know. And what we always try to say to our investors, both in the private market and public, is focus on performance. I know that historical track record is never a predictor of future return, but there are good investors and bad investors. And it's very hard to take a bad investor and suddenly make them a good investor just because they can raise money in multiple channels. So there's going to be a little bit of a dispersion in return, but that's okay. There's dispersion of return in the mutual fund business, right?
It also, though, feels that, yes, track record, but when it comes to more of the retail type funds, it feels like some of the selling, or at least redemptions, has been indiscriminate. And you can talk about what you're seeing on your platform as well. I know you've seen net inflows, not net redemptions. But you're seeing redemptions on platforms like Blue Owl or BCred when it comes to Blackstone that don't necessarily have bad performance. You can see where they're marking. So what is going on that you are seeing some retail pulling back from some platforms, despite performance which hasn't been as bad as the headlines would suggest?
It's a confluence of things. Number one, and it goes back to diversification. So if you are going to have a playbook to win consistently through cycles, you have to be diversified in your asset mix. You have to be diversified in the markets that you participate in from an investment standpoint, geography and other. And you have to be diversified in your distribution. And I think one of the challenges, and we experienced this, when we first started our private credit business, it was dominated by our traded BDC, ARCC. And we managed that, we think, fairly well through the GFC, acquired a number of troubled managers, and then realized that as wonderful of a structure the publicly traded BDC was, it was inherently pro-cyclical because we just couldn't raise the capital that we needed when the markets were dislocated, and we were getting capital that was coming into the platform when the markets were healthy. by the way, banks are pro-cyclical. There's a lot of pro-cyclical structures. So the light bulb moment for us was we needed to diversify our capital base, and so we moved quickly to build the institutional fund complex, those $30, $35 billion funds that you were talking about, so that we would always have the dry powder and the investment capacity to navigate changing market. And then once we felt that we had that well in hand, we said, let's go into the wealth business. But if you are over-indexed to wealth, you're going to be inherently pro-cyclical, and that's part of what's happening now. Now, the challenge is, I think these products are still in their infancy, even though the market is large, and I think they're misunderstood, right? These were not meant to be liquid funds. They were meant to be illiquid funds with an option for structured liquidity, and that liquidity is supposed to come orderly so that the folks that want their capital back and the folks that are putting money to work are not disrupting the fundamentals. So as of now, that's how the market's working, right? So you are going to see inflows, at least in our case, exceeding outflows. You're going to see in certain cases, that not happening, but the structure's working and that liquidity needs are being met. The other thing I would highlight, this is not a case of 100% of investors in a given fund wanting 5% of their money back. And I always just try to get people to focus on kind of the facts and not the noise.
Right.
When there's a 5% redemption queue, that could mean there are 3% of the investors representing 5% of the capital that want their money back. For some reason, maybe they're getting hit in another part of their portfolio and they need liquidity, right? It may not be a reflection of their view of that specific fund. But what that tells you is there's 97% of the investors in that vehicle that want to be in that product, and then there are new investors coming in. So this is something you and I talk about when we're thinking about how we tell the story of what's happening in the market. This is not an unwind or a lack of appetite for private credit. We are still seeing significant appetite across the spectrum of our 8 wealth products. There are corners of the market that are looking for liquidity, but there are still people that are allocating aggressively into it. And I think that's just, we're going to have to find where that equilibrium is. Different managers will have different experience, right, based on track record and size and brand and all of those things, but that's not necessarily a bad thing.
Do you think the industry will shrink as a result of all of this?
I don't. No, I don't. I look at our own experience as an analog. We have 8 semi-liquid products. They kind of ebb and flow in terms of investor demand. You can have significant retail demand for real estate. That gives way to demand for private credit and infra. But when you look at the opportunity for individual investors to get access to these assets, if you were to talk to the large wealth platforms, they're still seeing, a significant amount of demand for these products, and they will tell you from a model portfolio standpoint, they're massively underallocated.
Right. So if performance is healthy, I wonder what you make of this. This got a lot of attention last week. UBS saying that there could be 15% default rates in private credit. Does that sound right to you?
It sounds absolutely wrong, and when I saw it, I thought it was actually irresponsible.
Talk more about that.
And this is part of the problem when you have someone who's actually never been in a segment of the market making commentaries about what default experience can be. That's actually irresponsible. If you were to look at private credit, default rates have always lagged default rates in loans and bonds. So that's just something that people should take a look at. Default rates and loss rates have always lagged loss performance in bank C&I portfolios. So people should take a look at that. And if you look at the GFC, you would see that private credit portfolios as an industry were probably down somewhere 8 to 10% for 1 year default rate, and then rehabilitated. So if you're talking about 15% default rates in private credit, which again I think is just not possible, but if you're there, everything else in your portfolio, I assure you, is going to be completely torched. So we could talk about private credit specifically, but again, to decontextualize it from what that would be telling you about what's happening in the broader investment markets, I think is problematic.
What do you think the world is getting wrong then? Because you can't just blame the media in this case, which I know, I'm not saying you do, some of your peers love to, but if an institution like UBS is getting this wrong, what do you make of that?
Well, like UBS as an example just lost a significant amount of money in a loan called MFS, and that particular analyst didn't actually write a story about that. So I thought that was interesting. I don't think they're getting anything wrong, to be honest with you, and this is part of the signal through the noise, is the markets right now are so conditioned to react to any headline. And the reason they are, structurally, the public markets are fundamentally different than they were. You've got massive concentration of market share. You've got a significant amount of algorithmic trading that happens in the market. And most public equity investors are now focused more on momentum and positioning than they are in their ability to actually carry out a fundamental investment thesis. So I don't know that they're getting anything wrong. I think it's more of a commentary on just how investing in public markets works now, because you have to be out ahead of whatever that headline is, because that headline is going to drive momentum, and if you're not positioned appropriately, it hurts. So I think based on the velocity of the news cycle and the structure of the market, all you're seeing is investment behaviors changing, where we're not actually able to talk about long-term fundamental business plans.
Right.
And we're focused on short-term noise. And that's okay, but it's also one of the reasons why I sit here so confidently being in the private markets, because we know we have a business plan for every asset that we own. We're going to execute on it, and ultimately we get judged over 5, 10, 15-year increments as to whether or not we improve the value of those assets over time. And there's going to be volatility, to your first question. That's going to change the way that the business plan gets executed, but the outcome should hopefully still be the same given all the flexibilities we have to drive value.
Right.
And it's unfortunate because I think the public markets have moved away from that. Active investing in public equities is really difficult.
Yeah.
And it's difficult because of some of this, just the way that information is getting consumed.
By the way, as we've talked about how you've expanded the Ares platform. One area that you've also very expanded into, and I know we only have about a minute left, but I'd be remiss if I didn't ask about your sports platform and the growth there, be it investing in itself or offering to wealth investors. Why go all in on sports?
Well, we went all in on sports, first of all, because it's fun.
As good as reasons any.
It is a fascinating opportunity for us to participate in the development of a market that up until 5 years ago wasn't available to institutional or individual investors. So we want to be at the front end of innovation in financial markets, and we identified sports as an opportunity for us, given everything that we did, the nature of our capital, the nature of our relationships, to really change the way that business was getting done in the sports ecosystem. And two, from an investment outcome standpoint, it's almost completely uncorrelated to anything else that you can own in your portfolio. So when we talk to our investors about a broad portfolio of sports exposure, and we show them what it looks like against the S&P, against credit, and so on and so forth, what stands out most is just how unique it is in terms of what it delivers to the investor in terms of the outcome, the inflation protection, the compounding of value, the store of value. So it's actually a really unique asset class, and I think as more people have a look at it and more institutions participate in it, it'll become much more developed. And
Mike, I'm just going to leave it here because I think this is the only reason everybody's here. I'm saying in jest. The question everybody wants to know: how are the Baltimore Orioles going to be doing this year?
They're looking really good. Looking really good.
Tough season last season, though.
It was a tough season, which is part of maybe to bring it back to the markets. You don't know. Returns aren't always positive, but you hope over a long period of time they are. And so we had a drawdown last year, but we're actually really optimistic about the season ahead.
A perfect way to put it. Mike, thank you so much for
Dani.
joining me this morning. Everyone, please join me in thanking Michael Arougheti.